Hello, YouTube subscribers, loyal subscribers. How are you today? Hope you're enjoying your morning, afternoon, or evening, and you decided to hang out with me for a little while. I first want to start out by giving a shout out to Cornelius. Um, this is a requested video by this person, loyal subscriber. So, his question, or her question, was, hey, are you going to do videos on whole life insurance, like explaining it more in detail? You've done a little bit of videos talking about, the savings asset, how the banks make money, how, all the good things. But what if, you can make a video where it's like all the questions and the need to knows from the client's perspective, right? So let's dive into it. Life insurance is a question you'll have to answer at some point in your life, whether to get it or not to get it, right? You're either gonna, invest in something like this, acquire a product like this insurance, or not. How do you decide with the overload of information, right? Because on one hand, you have a big group of people that follow what Dave Ramsey says, how insurance is the worst things, it's terrible. Then you have another big group of people that are like, dude, life insurance is amazing and it's awesome and you can start a business and make a ton of money and yada yada yada. Then you have another group of people that are big in the insurance space and make a ton of money by misinforming people about insurance or hyping up the product to make it more than what it actually is. So it's tough. It's a lot of noise, just like our personal finances, right? You got Joe telling you to invest your money. You got Susie telling you to don't spend your money. You got Dave telling you to, conserve and save. Grant Cardone's telling you throw down 10x. It's like, damn, who do I listen to, man? Who do I listen to? Right? And you know my answer. Get your fantasy league in order. We'll make that happen. So, life insurance. I want to break it into three. Okay, because I like to work in threes. Okay, so you've got 90% of agents out there in the world that sell life insurance, period. Meaning, they're going to sell you the most death benefit they possibly can sell you for the most premium. Okay? Pretty simple, right? The reason why is all agents get paid from the premium. Okay? That's how they make their bread. Their commission is off the premium. So if they can convince you to get a $1 million policy, right? Whether it be a whole life, a term, an IUL, a universal, a variable universal whole life, right? All different types of life insurance policies, right? All the pitches is this. Hey, Denzel, what would happen if something tragically happened to you? Who's going to take care of your family, right? This is why you need life insurance. Okay, that's the pitch. That's it. One way, shape, or form, that's how 90% of insurance will get sold. Now, the second group of people, right? You've got 10% or less of agents Okay? I'm in this space, the 10% or less of agents that sell insurance for wealth creation. Okay? And there's two major ways that is sold. Okay? And I want to give you this information so you as the client can make a really informed decision on who to go to, right? And who to know, like, and trust that this agent, whether it be me or someone else, is going to serve you best. That makes sense? Yeah. So of this 10% of agents or less, I want to say it's like 8% of agents, right, that are selling a life insurance as an asset, as a wealth creation tool, right? Their goal is to minimize, right? Is to minimize on premiums, which means cost of insurance, and maximize on cash value growth. Okay? And there's two major ways this can be done. Okay? And it's really up to the client to decide where to go. So the two major structures in insurance are whole life and IUL. Okay? Whole life insurance, also known as dividend paying whole life insurance, also known as high cash value life insurance or cash value life insurance. Okay? And IUL stands for Indexed Universal Life Insurance. Okay? Now, some key things to know, and I'll explain both of them in detail, right, up in this area. So, you know, you got the 90% crew that are just selling insurance, just to sell insurance, just to sell life insurance, make a commission, and be on your way, right? And then when you break it down, you've got 10% of agents, so you've got maybe 5% on this side and 5% on this side, right? It's like half and half, okay? You got the whole life, you got the IUL, Index Universal Life. Here's how they work. Whole life, money goes into two places, okay? And that's it. Premiums and cash. That is it. These policies have a guaranteed floor, 4% interest growth on the policy's cash value, okay? Their average 4 to 6%, okay? Anything above 4 is called surplus or dividend, right? Inside of the insurance policy. Now, to break it down even further, there are 4 major mutual life insurance companies. And that is Mass Mutual, Guardian, New York Life, Northwestern Mutual. These are the titans in the space of whole life insurance, in the space of mutual life insurance companies. Denzel, what is a mutual life insurance company? Simply means that when the company makes a profit, when they have revenue, after they've paid their employees and their expenses and overhead costs and all that good stuff, the profits or dividends go to the policy holder, you and I. Okay, the policy holder, the client. And that's it. A stock life insurance company has 3 places they put their money. They have to pay employees, overhead costs, operations, whatnot, death claims, right? Then they have to pay their stockholder, okay? And then they pay the policyholder. So you are third in line after everyone else. So typically the performance of your cash is going to be less. So if you are meeting with someone that is a part of a stockholder life insurance company, you'll know, okay, this isn't the best vehicle for wealth creation. It might be a cool vehicle for a high death benefit with a high premium, or maybe it's a good enough premium or an affordable premium, and that's it. But if we're talking about wealth creation, right, inside of insurance, okay, then that's where we, step into this, and that's where it would be more ideal to go with a mutual life insurance company. And to make that even better for the client, the customer that is viewing, hey, there's hundreds of companies that are mutual life insurance company. How do you decide which one to go to? Well, it's pretty simple. Compare it to like Apple or Samsung, right? Don't nobody want to get an LG or any other phone like that. That's small market, okay? Everyone's buying Apple, and then everyone else is buying Samsung, and then everyone else is below that, period, right? So if you're looking to get a good phone, hey, iPhone, Samsung, okay? Same thing with insurance. If you're looking to get a good policy, hey, look at the 4 majors: MassMutual, Guardian, Northwestern, and New York Life. Okay? These are the companies that have been around for over 100 years, have long track records of paying 4 to 6%, even more back in the day, right, when the interest rates were much better and the dollar was connected to the gold and all that good stuff. All right? Nowadays, Fed interest rates are really low, therefore all other interest rates are really low. But guess what? When they go up, right? Well, like I said, when they go up, this will go up as well. Your policy will perform that much better. So that's a good standing good facts to know about this side on the whole life. So recap on it. Money goes into 2 places. Premiums or cash value. Today, 2018, the average rate, 4 to 6% guaranteed. The money that's in cash, I'm able to use it at any time to do the velocity banking method that I teach when we use lines of credit, other people's money. Okay, same thing here. Now, going over to the IUL side, okay, you have the other 5% or so of agents that are selling Index Universal Life. Now, how does this one work? Well, money goes into 3 places. Okay? Same thing. Premiums. Right? Cash. And fees. Yearly, annual fees that you have to pay inside of the IUL. Denzel, is there any fees over here? No. The only cost is your premium. Well, Denzel, why are there fees over here? Let me explain. Look, you've got the Index Universal Life, okay, is a whole life policy that looks at the S&P 500 or the index, all right, Dow Dow Jones, one of them. They look at an index and gives you the potential, not a guarantee, but the potential to earn. I've personally seen 15, 17% interest, all tax free, because we're talking about life insurance, so that money would be tax free. Okay, now not all IUL policies have a floor, right? Most of them have a 0% floor, which basically is trying to tell you that, hey, we won't lose any money. You know, so if the S&P, the index, goes negative, your policy will not go negative. Okay? There are other IUL policies that have a floor of 1%. I've seen some as high as 2. I'm not too sure if they go any higher than 2. If you're an agent that knows about IUL, hey, you can educate me. I'm 22 years old. Hey, maybe you could teach me something, right? 2%, 1%, or 0% floor with the potential to earn, I don't know, 15, 20% on whatever amount of money you put in. Okay? That's how an IUL works. Now, to break it down even more, hey Denzel, how does, the premiums work, the fees and the cash, okay? So, with the premiums, pretty much would work the same way as a whole life. The only thing that changes is that this premium increases every year to maximize on the death benefit to prevent a MEC. Okay? Denzel, what is a MEC? MEC stands for a Modified Endowment Contract, which basically is the IRS looking at your policy, making sure that you're not using it for investment purposes. Right? If so, you get taxed. Uncle Sam be like, oh, you're making way too much money inside that policy. Your death benefit is gonna be less than your cash value after X amount of years. Therefore, you're gonna MEC out. Therefore, you gotta pay taxes, and you don't want that to happen on either side. Okay, you don't want that to happen on either side. So, in order for this policy to, in theory, work, right? If it's producing 15 to 20%, the premiums have to increase every single year. How do they do that? There's something called ART, okay? Which stands for Annual Renewable Term Insurance. Annual Renewable Term Insurance. Now, all that is a term rider that adds to your premium every single year without you having to do blood work and medical for more death benefit. Now, obviously that's going to increase your cost of insurance on the policy. Okay? So as a customer, as a potential client, if you are being presented with IUL, something to consider is, hey, you definitely want to ask, hey, how do the premiums work? Are they guaranteed? Will they go up each and every year? Explain. If the agent is not able to explain, you might want to reconsider who you're liking and trusting for insurance to provide you with a genuine high performance insurance policy if we're talking about wealth creation. Okay? Now, the other thing that you want to consider, if you're on this side of the fence, are the fees. You want to ask, hey, what are the fees to gain this 15 to 20% potential, right? What are the fees, right? I've seen some IUL policies with fees of $1,500 a year or $1,000, or what they'll do is just say 1%. Okay? Mind you, 1% of the performance of the account, of the cash. So if your money is growing, so will the fees and so will the premiums. So you have to make sure that your policy will not lapse in the event that you don't produce 15 to 20%. Because the fact is that the S&P will go negative every how many years? I don't know, right? It might go negative 2 years in a row or 3 years in a row. It might go positive 3 years in a row, 4 years in a row. Okay? You're hoping for 15 to 20 so that you make up for the premium costs and the fees. And when you actually calculate it, right, you might end up on this side making 4 to 6%. But in actuality, you're paying a lot more in fees, a lot more in premium. So whoever you're sitting with, whoever is showing you, whether it be an IUL, right, or a different types of IUL, there's also equity, index universal life policies out there. There's quite a few. You can definitely play in this area and see, ask the agent for illustrations. Ask them for historical performance policies, right? Like you would say, hey, sounds great. 15-20%. Sounds great. I get a guaranteed death benefit, a guaranteed stream of income after I retire. Sounds great. Can you show me a historical policy that has performed for the past 20 years that matches what you're showing me today of the amount of money that I want to put in, okay? If they're not able to produce that for you, or if they don't know what you're talking about, you might want to reconsider that agent, okay? Same thing with this. Same thing over here. If you have an agent that doesn't know who the four majors are, that can't explain to you premiums, cash value, how it works, how to use it for velocity banking, right, or wealth creation, reconsider that agent. Even if they're your friend, you can refer them to this channel and maybe they can get some education, because the truth is, like I said earlier, 90% of insurance agents don't even know these two columns, right? They don't even know this. And then of the 10% that do know these two concepts, right, they're split in half, okay? And then you got to deal with that small group, right? You might have to pull teeth, right? Because of this 5%, not all 5% of agents are even going to know how this works. They just got into it and they started selling it, and they heard they can make a lot of money as an insurance agent. And yeah, you can, but you want to do it ethically. Okay, you want to make sure that you as the agent serves the client best. So you want to make sure that they win so that you win and the insurance company wins. So it's a win-win-win. Everyone's happy, everyone goes home. You have a nice relationship with your clients. Okay? So these are very good questions to ask. So to recap, hey, how do the premiums work? As a client, definitely ask these questions. How much are the fees? If you're looking at IUL, what are the fees? How much are they? What's the cost? Ask them about the performance. Ask them about the guaranteed floor, right? Because they change and alter. Ask them about the top IUL companies, right? Because there's quite a few of them. So you want to ask them, who are they? On this side, ask them, hey, do you know who the 4 major mutual life insurance companies are? What kind of premiums am I looking at? Right? How's the cash value performance? What's the guaranteed? Can I use this for velocity banking purposes? Can I use this for wealth creation? Can you show me an illustration? After you get your illustration, hey, can you show me a real policy or a historical policy that shows the performance and the track record of a scenario on both sides? Cool. So I hope this helps. Very basic questions. These are complex strategies without a doubt. The reason why is, major banks and corporations do this. So, if you are running the world, you better have a very complex strategic plan to run the world. Okay? So that's pretty much it. My name is Denzel. Hope you enjoyed that, and you have yourself a wonderful day. Thank you.